can be wise to trust our emotions, but something weird happens when it comes to investing. When markets are high, our emotions might tell us to go buy more, but when things start to fall, our emotional response is to want to sell. So this is the exact opposite of the ideal investment situation, which is to buy low and sell high. If you get emotional about your investments, don't worry, it's completely normal. And we'll explain in this video a few reasons why that is. The chart shows the path of investment performance through a complete market cycle, noting the investor emotions commonly triggered at each stage. Letting our emotions get the best of us can spell trouble in both the upswing and downswing. The perils of temptation during a bull run. History has shown us that markets always have their ups and downs. However, it's very common to get caught up in whatever the current state is. So for example, if things are going well, it's easy to think, well, maybe this time it's different and we're going through a period of really prolonged economic growth and that my portfolio value is going to continue to go up. In fact, this is the mindset that a lot of investors have had during the prolonged bull market of the 2010s. The danger is that an overly optimistic view can cause an investor to stray from what their normal investing risk tolerance is. So an investor that's usually a little bit more conservative may fall victim to the fear of missing out and want to jump on high equity prices. When they do this, yes, they might enjoy positive returns for some time, but they may become anxious or worry a lot about their investments as soon as things become a little bit more volatile. Someone nearing retirement, unable to resist high-flying markets, might move some of their savings investments into equities that they otherwise would have earmarked for fixed income. This may actually put their targeted retirement date at risk. The setbacks arising from acting on worry or fear. The feeling of this time is different also works in down markets just as much as it does in up markets. So for example, when we're going through a downturn and we've reached the trough or the bottom, some investors might think, well, this time it's different and we're never coming out of this recession or we're never coming out of this trough that we're in. Behavioral economists say that the psychological pain of a significant financial loss is twice as impactful as the joy of a financial gain. Some investors might have felt this gloom during the 2020 market correction, although it was very short-lived. Others might have felt it during the Great Recession of 2008 to 2010. Investors who worry that their financial portfolios or the value of their portfolio won't ever recover to its pre-correction value can keep in mind that even though past results aren't an indicator of future results, we do know that every market correction has been followed by a recovery and ultimately a bull market. Acting on worry can be harmful financially, and selling turns paper losses into actual losses. Directing new contributions towards high interest savings, GICs, or fixed income securities that were otherwise earmarked for equities can delay reaching financial goals. Temporarily halting contributions can mean giving up the opportunity to buy at discounted prices and instead being okay with buying back in. The remedy for emotional investing. Markets are going through an upswing, you can be content that you're prospering. To the same point, when markets are going through a correction, you can be patient. As well, if markets are going through an upswing and you are happy with the profits that you've made, consider cashing out for a brief time and recognizing those gains. Regardless of the situation, it's always best to stick with your investment strategy. And remember that a diversified portfolio should help smooth out the volatility. The market is full of ups and downs, but knowing how to manage your emotions during these times can help you ride it out. As well, by making regular contributions instead of lump sum contributions, you can be sure that you're not always investing when things are at their highest, but you can also be sure that you're taking advantage of lower prices when that occurs. If you're feeling anxious about your own investments, we can review it with you. Our team at Ferguson Financial Planning would be pleased to meet with you, and you can book a consultation with us using the description in the link below. We also update our website regularly with market commentary and tips like this. If you liked the video, be sure to subscribe and like, and leave a comment. Thank you for watching.